Welcome back. And let's move on to non-mortgage asset-backed securities. Thus far, we've been looking at ABS that are backed by mortgages. Besides MBS, there are ABS that are backed by various types of financial assets, including small business loans, accounts receivable, automobile loans, and credit card receivables. Each of these types of ABS has different risk characteristics, and their structures vary to some extent as well. One way to distinguish is to segment them into amortizing and non-amortizing loans. As we've covered earlier, the mandatory regular payments for amortizing loans include both interest and scheduled principal repay. In contrast, mandatory regular payments for non-amortizing loans is the interest only. Principal repayment is only required at the end of the loan. This difference in the principal repayment requirements has significant influence in the structure of the ABS. We shall illustrate this with auto loans and credit card receivables. Let's start with auto loans. Auto loan ABS are backed by loans for automobiles. Like mortgage-backed securities, such loans are pooled and securitized to form the ABS, which are sold to investors. The cash flow components of auto loan-backed securities include scheduled principal payments, interest payments, and prepayments. Auto loans are fully repaid if the cars are sold or traded in. Prepayments also occur if the car is stolen or wrecked and the loan is paid off from insurance proceeds. If a borrower defaults on payments, the car can be repossessed and sold, and the proceeds are counted as prepayment. Or it could simply be the borrower's choice to prepay to reduce future interest payments. Most auto loan ABS incorporate some sort of credit enhancement to make them more attractive to institutional investors. Many have a senior subordinated structure with a junior tranche that absorbs the credit risk first. In addition to such a structure, over-collateralization is also a common form of credit enhancement for auto loan ABS. For example, if a total of $10 million of ABS is to be issued, there could be a total of $11 million worth of loans to give the investors additional buffer if some of the borrowers default. Besides over-collateralization, another credit enhancement method is to create a reserve account. For example, if the aggregate interest to the pool is 10%, the ABS can be priced at 9% interest, with the balance 1% known as the spread going into an excess spread account. The amount in this account can be the first to be drawn down when losses occur, giving investors additional buffer against credit risk. Let's move on to an example of non-amortizing loan-backed securities. Credit card receivable-backed securities are ABS backed by pools of credit card debt owed to banks, retailers, travel and entertainment companies, and other credit card issuers. The credit card receivables from these institutions are used as collateral for the issuance of credit card receivable ABS to investors. For a pool of credit card receivables, the cash flows consist of finance charges collected, fees, and principal repayments. Finance charges collected represent the periodic interest the credit card borrower is charged on the unpaid balance after the grace period. The interest rate may be fixed or floating. The floating rate may be capped, that is, it may have an upper limit because some countries have usury rate laws that impose a cap on interest rates. Fees include late payment fees or any annual membership fees. As we've noted earlier, credit card debt is non-amortizing, meaning that there is no scheduled prepayment of principal. As such, credit card ABS is structured such that the principal amount is maintained for a period of time known as the lockout period. During this period, only the finance charges and fees are passed on to the ABS owners. If any of the borrowers make a principal repayment during this period, the cash is used to purchase additional credit card receivables. This keeps the overall value of the principal relatively constant during the lockout period. After the lockout period, which can last from 18 months to 10 years after the ABS was created, principal payments are passed through to security holders. This should continue on until all the outstanding principal has been repaid, after which the ABS is retired. Some provisions in credit card receivable ABS require early amortization of the principal if specific events occur. Such provisions are referred to as early amortization or rapid amortization provisions and are included to safeguard the credit quality of the ABS. The only way the principal cash flows can be altered is by the triggering of the early amortization provision. And that concludes this short lesson on non-mortgage ABS, where we studied in particular auto loan ABS and credit card ABS. In our next lesson, we conclude this topic with a discussion on collateral debt obligations. See you again.